Welcome to another Mr. James Accounting tutorial. Today we'll be looking at Accounting Unit 2, Paper 2, 2021, Module 3. And this would be a good time for you to subscribe to the channel if you have not already done so. And I would also like to thank you for looking at the skippable ads. That is how the channel gets to remain free on the air. Part A defines the term standard costing. Since it's worth only 2 marks, it should be very brief. Standard costing is a costing system which uses predetermined budgeted costs for the 3 elements of cost. The 3 elements of cost we know to be raw materials, direct labor, and overheads. So when you set standard costs, or you determine the cost of these elements before you begin to produce, that is called a standard costing system. Hubs Limited is in the process of establishing direct material standards to use in its revamped budgeting process. Outline the 3 steps in the process of establishing standard direct material standards. For 6 marks. So just 3 steps you need to outline. The first part B. Discuss the following statement in relation to the use of budgets in an organization. A budget assists managers in managing and controlling activities for which they are responsible. And for that we have 5 marks. The answer should contain some of these items here. I will be very brief, but you can expand upon the points that I make here. Budget assists managers in controlling their activities through a process. Part C. Let's see what is required. Prepare a purchases budget for the 3 months ending April 2021. Use kilograms for the unit of the products. Okay, let's take a look at the body of the question. Hubs Limited has provided the following budgeted production data for the 3 months ended April 2021, and we are given the month from January to April and the amount of units that is required to produce. 3 kg of material are required for each unit produced, costing $12 per kg. Target closing inventory each month should be equal to 25% of the production needs for the next month. Material inventory on 30th of April was 66,750 kg. Okay, so let's get right into it. Okay, again we can use a format like this. Hubs Limited purchases budget for 3 months ending 30th of April 2021. We put in the production units at the top, and the important thing is the formula here. The production units is equal to the required production and the desired ending inventory. You'll get the total amounts required, and then you multiply that by $12. Okay, so you take the production and you multiply it by 3 kgs per unit. You'll get how much you require for production. Then you put in the desired ending inventory because you have to add that one also. And you start from here. You need 66,750. You have that in stock already for April. And from to get March, it would be 25% of this. And February would be 25% of January figures. When we add these two, we will get the total required multiplied by the $12 per kg, and we will get the purchases budget here. This is the amount we will have to pay for each month. Okay, let's move on to the next part of the question. Part D. Let's see what is required first. Calculate the net present value of the machine purchase and determine the discounted payback period. Okay, let's see what the body of the question says. Hubs Limited is considering expanding the production capacity with the purchase of new machines. The machines are expected to cost $700,000 and will have a useful life of 10 years with zero salvage value. The company uses a discount rate of 12% and expect an annual increase in cash flow as follows. Okay, so we are given cash flows, and this question would be different if you were given in net income. And we have the present value factor here. Okay, 12%, the rate is 12%. So it's a straightforward question to calculate the NPV and the discounted payback period. The NPV is usually on the cash flow, so you can use these figures here. You will disregard the depreciation. If we had net income here, you would have to calculate the depreciation and add it back. But let's get right into it. Okay, so I have prepared the answer here in a table form. We have the years in this column, the present value interest factor, the next column the cash flow, and then the NPV. We get the NPV by multiplying the interest factor by the cash flow, right? Because NPV uses cash flow, we don't have to add back the depreciation to get net income. Okay, so the interest factor for year 0 is also 1. Year 0 signifies the beginning of the project. Okay, there's a cash outflow. That's why we have it in brackets of 700,000. And when we multiply 700,000 by 1, which is the value of the money, it is equal to itself at the first year, and it's 700,000. In the first year, we take the interest factor, we multiply it by the cash flow, we get the NPV for that year. The second year, we do the same. Third year, we do the same. Fourth year, fifth year. Then we add this down. Remember, this is a negative figure here. It's an outflow. When you add in, if we add these down, we'll get a positive NPV figure here. Because it is positive, it means you can go ahead with the project. Turning to the payback period. To get the payback period, we have the outflow of cash here. Since it's discounted cash flow, we will use this figure here, the discounted figure, rather than the cash flow itself. So it will be 700,000 minus the 178,600, and we will have a payback period balance at the end of the first year of 521,400. Next year we will receive cash of 199,250, which will further reduce the payback balance, the 22,150. Then the following year 213,600, and we will come down to 108,550 left for the fourth year. And this would be paid, more than paid off, when we get this cash flow here. Okay, so to calculate the payback period, it would be 1, 2, 3 years, and the number of months it would take for this amount to be paid off in the fourth year here. We calculate that, we 108,550 divided by this, and we multiply it by 12 to get the number of months, approximately 9 months. So a discounted payback period is equal to 3 years and 9 months. And that brings us to the end of this question. Hope it was beneficial to you, and I want to remind you again that look at the clickable ads. That is how this channel would remain free to you. Have a good day. See you in the next video.